Alrighty, boys and girls, we had a wonderful weekend. Did you have a good time? You having fun a little bit the sun Monday morning? Sunny Monday morning. So, just to finish up on our last lesson about equities, firstly, if you have any questions about the homeworks or about the previous lecture, anything at all, everything is good? Everybody is more or less on the same page? All right. So, just to show you a kind of a long-term chart of total returns. Total returns are inclusive of the dividends. And, well, this ends in mid-2015, but it goes on for a couple more years, and I guess it's up here already. So yeah, equities are a good investment long-term if you can tolerate this. So this would be about minus 40%. All right, and what I'm going to show you in probably our last class before the exam is how a portfolio comprised of both equities and bonds would have performed during this entire period, or showing you maybe if we bought the portfolio at the wrong time, just before this crash, how the things would look like. Doesn't mean that this is what will happen in the future, but you will undoubtedly get the message that long-term returns if you give them a long enough time are positive. Okay, and that's very important. That's very important both from kind of a factual, what has happened, and going forward, what's likely to happen, and also theoretically, and this is the only theoretical part in this course that's coming from me, is why should expected returns be positive? Okay, so we're not going to go into really no equations here, but that's the one philosophical thing I want you to think about and take with you. And also trust me that expected returns on assets, capital assets, that is stocks, bonds, which are more the same than they are different, loans of various types, real estate investment, okay? All of these things are good things for the investor, and also most times for the borrower or the issuer, otherwise they wouldn't have done it. So we gotta assume that it's kind of a win-win situation, at least on average, at least for most deals, at least ex ante. Okay, and this concept of ex ante versus ex post, I don't know if you've encountered this in your other classes. So just to quickly to explain, ex ante is, let's say there's gonna be a lottery now. I'm gonna invest, either it's gonna work out or not work out. So I'm going to weigh in the probabilities, and then in expectation, ex ante, I think it makes sense because the expected returns are positive and the risk is something that I can tolerate. But ex post, after we looking back in hindsight, either it was a really good investment or not such a good investment, depending on what had actually realized. So you can make a right decision ex ante, but in hindsight you were wrong. It doesn't mean that you shouldn't have taken that decision. It's all about being right ex ante, okay? And this concept, I call it memorylessness, is very hard to internalize in oneself. So remembering that at this point or this point, at any point, expected returns are positive, whether stocks just recently went up, whether they went nowhere, or whether they just went down, that's history. But going forward, they should and are most likely priced to provide a positive expected return. Otherwise, nobody would invest. Okay, and most of the companies issuing debt and equity, if prices are so high, then they would sell a lot. Okay, if prices are so low, then they would buy a lot, such that prices would adjust until they make sense to provide a positive expected return going forward. ex ante. Now ex post, it could be that we just bought and something bad realized in the economy or with this particular investment that we didn't anticipate, and then looking back, ex post we made a mistake. But it doesn't mean that ex ante we made a mistake. And vice versa, if you're always making ex ante mistakes, then if you got lucky one time, then okay, that makes it a lot more easier to educate you. Because if you got lucky by making an ex ante mistake, but ex post it worked out, well, you give it a few more shots, and then you'll come back for the lesson. So again, about this expected returns, why they should be positive. So there's always this kind of confusion because nobody really put it down and made you write the T accounts, and so some of these things they're not complicated, but they're just a little bit too abstract, more abstract than you can just figure out in your head without writing down. And then, you know, lazy people, then they never do it, and their entire careers they never figure out. And I wasn't any better, okay, until I sat down. For years I was going by technical analysis and stuff, and I'll explain to you that this doesn't work. So this confusing thing is that people think, wow, these things trade, there's nothing to stop people from buying up Tesla stock until its price is so high, and then it can be obvious that expected return on this or that asset, because it trades freely in the secondary market, can be negative, ex ante, right? Has anyone ever thought that prices of any one asset are much too high or much too low just because it's gone up or down, and you see it always going up and down, and you're thinking to yourself, wow, there must be some people out there that they just buy or sell because of their psychology or whatever, and this resulted in prices being way too high, such that it's obvious that expected returns are negative, or that prices are way too low, such that it's obvious that expected returns going forward are not only positive but highly so. Has anyone ever thought about this? So, well, it doesn't matter, but the thing is that you have to remember that these things are not just objects that there's a fixed amount of that trade, and therefore their price can go to the moon, and there's no mechanism to bring their prices back down. So if, say, a bond's price is trading above par value and above whatever the coupon rate is, then expected return on this bond would be negative, right? If you're buying something for 110 and the end payout is only 100, you know this, that's what the notional amount of the bond, then expected return is negative. So you might think, what's there to stop people in the markets from getting overly excited and bidding this whatever Tesla or whatever that's kind of hyped to prices that represent a negative expected return going forward? And the answer is, well, the primary market. Okay, so an issuer, a company which sees its bond trading at negative expected returns. Now forget for a second that in Switzerland you have kind of sustainably negative interest rates on some assets. We're going to talk about this soon. But just think about the real rate relative to the risk-free central bank rate. So that should always be positive. The reason, one of the reasons, is that this thing is dynamic. So the issuer, if he sees that, is going to think to himself, wow, I'm CEO of the company, I'm going to tell my CFO to go and issue more of this bond or more of a very similar bond, because we can not only get money to finance our activity, which would be to buy buildings or whatever, expand our business, which would, most likely create positive expected profits for us, but we even get paid for it if interest rates are negative, if the price of the bond is so high. So what we would do, I'm going to tell them then, you issue as many bonds as possible at that price, and even up until a certain threshold of a price. And then that would bring prices down. Okay, so it's a dynamic thing. It's not just, you always have to remember that these are not just like items from that are given. Okay, their supply can increase and also decrease. So it's the same with equities. You always have to remember some of these examples are easier to understand if you're talking about a simple loan or a simple bond, but it's exactly the same as with equities. Just the example is could be a bit more complicated to transpire, but the similarities between equities and bonds are much more than their differences. The same thing with equities. The stock price will never go so high ex ante. Okay, you never know, because what will be the company's earnings is uncertain, and therefore what will be the company's dividends is uncertain. But ex ante, nobody is going to buy equities if he thinks ex ante that they are so overly priced that the expected return going forward is negative, right? Nobody's going to do that. And similarly, companies, Apple and you name them, if they think that their share price is so high that the expected return on them is negative, then they wouldn't mind diluting the existing shareholders by selling more equity shares at that highly inflated price to get the cash and to generate the profits. Just do the math. So it all depends, and that would bring again the price of the share lower, because companies would say, wow, something's wrong with stock market participants. They're so happy that they're willing to buy our shares at such a high price, and we're making such small profits. Well, how this is clearly unsustainable. Then I'm going to tell my CFO, we have this amount of authorized shares, of which we've issued only this much. So this amount is still, we can issue without asking anyone for even permission. Go ahead and issue those shares first time. So we're going to issue shares, paper out of thin air, me and my CFO, and we're going to get cash, hard cash from the market, and then we're going to use this hard cash to buy, things that make sense, like buildings that give me 5-10% yield or whatever. And actually, we're diluting existing shareholders, but very little compared to what we're getting. Just do the math. It all depends on the price per share that we're fetching. Similarly, if the price was too low, I would tell him, well, we have some cash. Why don't you, instead of investing this cash into more of our business, why don't you buy back our own shares? Because we'll be doing the opposite of dilution to the existing shareholders, but at a very low price, such that the price per share is going to increase. Okay, so we can always manage this. This is perfectly within the law and perfectly moral and logical, and companies do that all the time. So, and then of course a share issued first time is identical to a share trading in the secondary market, and so this is one mechanism that kind of in a hard way brings prices back to normal. But of course these things can take time. Tesla stock can be overvalued for a long time, and you never know. It's very difficult, especially with equities, because unlike bonds or loans, which have clear interest rate assigned to them, and then all you need to kind of figure out is whether they're going to pay back or not. And equities, you don't really know what kind of dividend you're going to get, and anyways, the volatility in it is much higher as a result, and so equities, they tend to be significantly more volatile than fixed income instrument. Fixed income is loans and bonds. Yeah.
But this is under the assumption that companies like in the past have bought their own shares at whatever price so they can sell it, or is it that they just issue new shares?
The companies can issue new shares.
But they have to have the approval of the existing shareholders.
Yeah. Okay. So usually it's like we said, there's a certain kind of high amount of authorized shares, of which only a certain amount is or in effect being issued, and then that leaves you with some slack
Oh,
that they can go even without asking for approval. And when that is exhausted, then they need to go and ask for pre-approval. So that's actually how it works. So they have, and that could be significant. This slack can be significant because what's written in the constitutional documents of the company, as mentioned last lesson, could be kind of arbitrarily high, leaving the amount of slack between issued and authorized to be huge.
but that wouldn't be very popular for the existing shareholders.
It all depends, as explained, on the price per share. And you do the math. Okay, now so you do the math. Now I'm gonna ask you to make a T-bill. It all depends on the price. There is a price. It all depends on what you do with the money as a company and the price at which you sold it.
Yeah, for the company, sure, but for the
No,
existing
for the existing shareholders. So let's say you and I start a business now. I put $100, you put $100, I own 50%, you own 50%. Now we got this lady. She's let's say, okay, she's not so savvy, okay? She's not so savvy, and she's willing to pay. So I have one share, you have one share. We decided, with the management and board, we decided to issue one additional share, and then whoever buys this share will participate the third in the profits of our company. And then we issued this share to her. We put 100 each, and she put 200 for that one share. So together we have $400. I have one share, you have one share, and she has one share. But she paid 200, I paid 100, and you paid 100. Okay, now with this 400, we're making a profit of, say, another 100. So the value of our assets and equity goes from 400 to 500 after 1 year, and then we liquidate the company. So then we each get and then we liquidate, and then 500 divided by 3 is how much? 167 each. I made 167 profit, you 67 profit, she lost 33. So it's good for us, bad for her. Okay, you would agree for that. You would agree for that price. You would agree to issue more shares. You wouldn't say, oh, but that's dilutive. I say, yes, it's dilutive. It's not dilutive. It's the opposite of dilutive. Okay, so you got to do the T-bill. You got to do the accounting. Otherwise, you're just taking words like dilution. You're taking words like dilution, and you make decisions based on buzzwords, and that really doesn't help you. Okay, so a little bit philosophical discussion about what is something that you would buy that would give you a positive expected return ex ante, and what would give you a negative expected return ex ante. So yeah, think of, and again, this is as philosophical as it gets, and this is one point that I want you to think about, because yeah, we talked about basic mechanics, basic accounting, but yeah, I want to bring home this one conclusion and this one philosophical, that borrowing and investing makes sense. Otherwise, this whole profession, there wouldn't be so many people. Now, there's too many people in this profession because so many of them don't know the very basics, and that's one thing that I'm saying. But this is this brings home tries to bring home the conclusion that finance makes sense, at least for the investor. So when you buy a house for the purpose of renting it out and collecting rent, then you don't question, you're not going to argue with me. That's intuitive to you that the expected return is positive. Because if the price is more or less stable, without assuming that the price would go up or down, just you see it that kind of stable, then you get your mietzins, you get your rent, then you're not going to start arguing with me that expected return is positive. Maybe it's not that high, but it's positive, right? So that's intuitive for you to understand. Now, why is that? Why is that? Try to think, why is that? There's a person inside, there's a person paying us rent, right? This person needs a house to live in, right? And he doesn't have the capital to buy it. So he's kind of working for us. I want you to keep that in mind. There's a person on the other side that he's on the hook to work for us. Otherwise, we can kick him out under some protection of consumers, but let's assume that. Interest on the loan. Same thing, you're not going to argue with me that a basket of well-diversified personal loans that people have to take because, you know, there's a thing, I don't know, you guys mostly live in Switzerland, I don't know if you're familiar with this concept, it's called poverty. But in such a dire situation, people sometimes need loans. This is a joke that I say often, I mean, don't take it. So, sometimes people need loans. You don't question that, you know, banks give loans and other lenders give loans. You don't question that expected return on the loan to the investor is positive, right? Because you see the interest rate. Yes, there can be some defaults, and maybe we lent out too much money, but on average and over time, you see that the expected return, the realized average return is positive, right? You're not going to argue with me about this. And again, why is that positive? Because there's a person, and he's on the hook for paying us back principal and interest. Otherwise, we go, there's courts, and it's a legal agreement that we've signed, and up until certain, you know, actions that we can take and enforce against him, and it's unpleasant, and there's a credit registry, and get the Betreibungs, you know, a default on your credit history, that stays forever. And maybe that's not so scary as much as taking the house. Yes, maybe you have a mortgage, but in addition to that, you have a personal loan, but you can lose the house because you didn't pay on the personal loan. And if you have a car, take the car. Okay, so there's a person on the hook there working hard for us over time to pay us back, to make our expected return positive, to make our return positive. Same thing with dividend plus stock appreciation on stocks, okay? To going back to the primary market, you have to remember always, because people get excited about finance because of the charts. But the charts is already at the second step. This is already after the real finance work is over. The real finance work is to do the valuation on the company, put the legal agreement in place between the company and the shareholders, and all the relevant covenants to make sure that investors are safe and that the company will have the right governance structure to execute on its strategic plan to make money, and that when they make money, they don't just take for themselves, but shareholders see the dividends that they signed up for. Then this is the real finance work. By the time it just goes up and down, that's already after the real finance work. Okay? So think of a company issuing stock first time. People wouldn't invest unless all this legal and, you know, operational structure was in place to make sure that they do make profits with our cash using a profitable kind of makes sense, common sense business activity. And again, then we wouldn't give the money if there wasn't expected dividends and expected positive return for us, and so on. And again, what's the source of the positive expected return here is that, yes, it's not a person, it's a group of people, it's a legal entity, it's a company that they issued shares. And again, just remember, shares are no different from a loan in most respect, in almost every respect that's relevant to you. And they're working hard to execute on their strategic plan, because there's a mechanism in place where if they get a lot of shares themselves, there's a mechanism in place to make sure that the incentives is right for them not to F it up, okay? And that's the point, that's what I'm trying to bring across. There's a group of people or one person that's working hard for you, or a family that's working hard for you to pay you back with principal and interest. So there, the borrower or the issuer is doing whatever it's doing, buying material or making iPhones and selling them for a profit, making marketing or building a building. They're doing something, or working daily and getting monthly paychecks so they can pay the mietzins to us, the rent. This is the source of the positive expected return. What about if you just buy a piece of gold, or if you just buy even, forget about gold, because that's kind of a special case, the gold historically was something, but think about metal chairs, okay? Not even this chair, because this wood can rot, and after a while, just think of a perfectly non-depletable chair that lasts you forever from metal. If you buy $1 million worth of these and you do nothing with them, intuitively you don't expect to make money on this, right? Unless you're really a speculator and now you look at the price of iron ore and you think that price is gonna go up. Unless you're really a speculator, you don't expect to make money on this. Right? Somebody argue with me, nod yes, nod no, smile, yeah, okay. So, what's the difference here? Okay, the difference is, what's the difference? Anyone got a clue here? Want to put a guess there? Kind of an intuitive explanation. Yeah.
Will there be a non-financial value in shares?
Yeah, okay, what do you mean?
Yeah, sitting shares then.
Hmm?
Because otherwise people wouldn't buy them.
Right. Okay. Some people buy chairs, right? Someone owns each and every chair, except those in the junkyard.
Yeah, and I would say there's a value to it, but it
Yeah.
does not. You expect not to get money from it. You expect to sit on them.
Okay, okay, yeah, that's getting close. Any other kind of explanation, trying to put into words what we intuitively kind of feel inside? Nicola, any kind of explanation?
Maybe when you get rent, you get monthly paid, and when
Right.
you chair, you just maybe sell it. Usually you don't get money from it,
Right.
and it's like, I don't know. Yeah,
So,
yeah,
you
it's-
guys are getting very close to how I try to explain it. And how I try to explain it is as follows. The seller or maker, the seller of the chairs, he's not on the hook legally. There's no loan agreement between you. There's no mechanism for him to pay you back rent, to pay you back dividends. He doesn't owe you anything. He gave you the chairs. Now the money that he has, now money is a kind of a pivotal thing in our society, that with this money he can now convince other people to do whatever for him. And so, but he doesn't owe any money back to us, right? He just sold us the chairs. So there is nobody on the hook there that's working kind of hard for us daily to make sure that we see a profit from transferring our cash to the seller name and seller giving us the chairs. Okay? But the one way, and the reason why people buy chairs, is because they need them. So they're making rent on them. You cannot build a university without spending some money on chairs, right? And the people, you pay rent, okay? So you get the rent from it, from the people, the students that need to sit down on chairs, and they pay the rent. And you're gonna work, I don't know how you finance your degree, but that's money coming out of your pocket, right? So that's how you get the rent from the chairs. You need to work them. But if you just buy and sit on them yourself, $1 million chairs, $1 million worth of chairs, and you just yourself, you know, like you do nothing with them, then you're not gonna make a positive expected return. Okay? Because prices are set this way that people are willing to buy chairs up until you know, what they get from them, from rent, from students or whatever, you know, movie theaters and so on. That makes sense to them. But if you just buy them and not work them, then you're not going to see a positive expected return because there's nobody on the hook to pay you. But the students are paying you because you managed to get them to sign their tuition bill. Okay, so that's the intuition. That's the intuition. There's a story I told you, but don't sit on the merchandise. Okay, don't sit on the merchandise. You got to work the merchandise. Okay. It's the same logic for a company. Now, okay. Now you agreed with me that expected returns are positive, but now maybe you have some kind of other logical problem that you were thinking, well, okay, but how do you square that with money? Kind of, you know, maybe there's kind of a finite amount of money. I've shown you that there's actually zero amount net money, but depends how you count it. The base money is always growing, but let's say it was fixed. Then you guys must have some logical problem. Say, well, if expected return is positive, then how come the richest person doesn't have all our money? Right? How does that work? And the answer is that yes, capital is a natural monopoly. The more money you have, the more money you can make. And you do see the rich people getting richer. Okay, you see the dynasties, the families, if they're able to pass on the knowledge to the children, then yeah, you have these families from history that they're still around, and they got billions worth of assets, and more than billions. So it does work like this. It doesn't mean that all of us have zero, but that's how society works. So it can coexist. And now other examples. How can it be that people get paid different amounts for their labor? I mean, some people make more than others, but you don't see that the highest paid person over time, because someone needs to continue paying him, you don't see him getting all of the capital in the world, right? He just makes more, that means he has more, and over time, because if he invests it's even more, but it's not like he's sucking all of 100% of the capital from the economy, just to him. So these things coexist. These things coexist. That you can start from zero and start selling your labor and start investing, or you can just work your capital and make more capital on the capital. And it's a fact of life that capital begets a rent. Begets is some old English word, but doesn't matter. That if you have capital and you're buying financial assets with the correct legal and other setups, such that whoever is receiving your capital is on the hook to work hard for you and then is making profits for you, as opposed to just buying chairs with it. So if you have capital and you're doing the right thing, then you will make a positive expected return. There's rent on the capital. I didn't invent this, so don't look at me like it's not fair. I didn't invent this right now. This has been around since day one. Okay, it's been around since day one. So I'll just read a little bit about this, and just like my philosophy is that I've met all these people. I've worked with Nobel Prize winners and CEOs and chairmen of large institutions, and these people tend to like me. I don't know why. And self-made or inherited wealthy individuals, generals in the army. I've met all these people, and what I learn from them and what I learn from everyone, what I see from myself as I get older, every day you wake up in the morning, now what? Okay, you always want more of something because you're still alive, right? You have already this and this and this and this and so much money. You never need to work, but you still wake up in the morning. What are you gonna do? You gotta do something. Okay, so that expected returns are positive can be derived from people wanting more, and people wanting more is because people are still alive, and so expected returns are positive. I think is just the basic result of people being alive and knowing that it's gonna end at some point. Okay, this is my philosophy. Expected returns are a direct result of the finality of life itself. So I want you to just think about this. So how about we take like a 5-minute break? When's the actual break? 10 minutes? Okay, so let's take a 10-minute break now, and then when the bell rings, we come back, and then I switch up to the next presentation. And this is a rather short presentation that I want to go a bit more into details about what it is exactly, these mechanisms to make sure that this person or legal entity or company on the other side are paying back, or paying us dividends, or paying us the interest back. Okay, so it's easiest to talk about loans here, but it's all the same thing about equity investment. You remember the shareholders agreement, we can put a lot of covenants, a lot of restrictions on management. such that indeed they'll do what they set out to do, and they're not going to clean us out from all the profits by increasing their salaries if we're the shareholders. So it's the same thing, but but you know, people don't really give out loans one to each other, right? There's specialized companies that do lending, right? And they also need to finance themselves in one way or another. And there's a reason for that. So, and this is the beginning of this profession, financial intermediary. So just to go a bit more into the details here. So direct finance is a lender and a borrower. They get together, they agree on loan amount. Everything is written down with the loan agreement. This is my first loan, by the way, I did like this. So I actually wrote everything down with a person, a binding legal agreement and everything. And with collateral too. And there's a big problem with that. There's a big problem with that. But before we reach the problems, then the lender owns directly the loan asset. Okay, so we have legal and economic ownership of the asset. It's an asset, just like this is my car, then it's registered somewhere, and the loan agreement says that I'm the lender. That means I own the loan. If I want to sell the loan to someone else, then I can do that. Of course, the loan agreement can say that I may not sell it to anyone else. We can put this restriction in there if we want to, but potentially if we don't put that restriction, then I can sell it just like I could sell any asset of mine. Again, there's a legal agreement. Maybe you guys want to Google one time loan agreement template and just read what's on there. And you're gonna see that it's not rocket science, okay? It's not rocket science. Just a little zettel, just a little note with the Unterschriftli, okay? With the signature, and this is binding. You know, you can take this to court, and you know, you can do what the banks do. The point is that the law does not discriminate in favor of a bank lender than a personal lender. Okay, if I'm just an individual and I lend an amount to someone, I can do to him what the bank can do to him. It's only going to cost me a lot more time and effort relative to what it would cost the bank per dollar, right? Because the bank has economies of scale. The bank does this for a large amount, and then they have responsible people for every phase of it. It's everything smooth line, and that's when we get to the problems of direct finance, right? The economies of scale. There's huge, quite well. Let's not say huge, because they're not really as huge as people think. There's large barriers to entry into the finance business. As far as a new company that wants to start brokering or intermediating capital between borrowers, and this could also be equity. I'm just saying borrowers, issuers, and lenders. And again, it doesn't have to be a loan, it could be an equity investment, doesn't matter. But intermediating between these two parties, there's large hurdles to entry, not huge, but there's large. Mainly, the main problem on the operational side is the IT system to account for everything. Okay, the accounting, that's the actual kind of back office work that needs to be done, and that's requires expertise, and that requires systems. The systems you have to buy them, unless you can code them yourself. That's what I did, but that's unusual, and you need accountants to operate them. But the business problem is what people call business development. Business development, in this instance, I would mean finding all the deals. So if I'm financing real estate deals, I don't have the money for myself, but I'm finding these good deals, and then on the other side, I'm finding investors for them. So to find the deals, I need people and I need advertising, and also to find the investors, I need efforts to raise the funds, to give presentations and explain, show a track record. So these three things are really the big problem. But of course, if we're talking about just a loan that I gave to someone and he doesn't pay because he thinks that I'll never pursue him in court, and he might be right, because now going to court, there's some fixed fees for just to start the processes, and maybe I never really did it, so now I need to pay a lawyer kind of a substantial amount to hold my hand and teach me how this process works, as opposed to if I already had so much experience, then I wouldn't even need to pay a lawyer because I could just do it myself because it's a standard process. So that's on the collection, and also on the legal. The legal requires some expertise. So these are barriers to entry, but they're not nearly as large to justify the existence of these monsters of banks that exist right now. Okay, you can find many local lenders that lend for real estate or lend to individuals, that they broker maybe $250,000 per month, and there's just like 4 or 5 people working there, and it's profitable for everyone, the borrowers, the lenders, and the people that do the brokering. Okay, so there is stuff like that out there. So a team of 4 or 5 can start already a finance business. Service finance is when all this work to do the accounting, to do the legal, to take the person to collections, to court if necessary, to find the deals, and to find the borrowers, and to find the lenders, that could all be delegated to what I call a servicer. Okay, it could be a company, a finance company, that they find the borrower, they find the deal, they do all the due diligence about the deal if it makes sense. If it's a loan, then they do the credit decisioning. Okay, that's a professional name, credit decisioning. They decide whether this person is worthwhile to lend to, what amount, what interest rate, what duration, what collateral, if any, is required, and the verification of all the information. So the lender and borrower can still be direct counterparties on the loan agreement. The loan agreement specifies firstly between lender name and borrower name. Okay, so that's the essence of the loan agreement, and then all the terms, the interest rate, the amount, and so on. But it starts with who's lender, who's borrower. That's any legal agreement, and also any dispute in court starts with defendant and the other, I forgot the word. So that's how it works. There's always at least 2 parties to any legal agreement, not just loan agreement. Any legal agreement has at least 2 parties, and there are still direct counterparties, but the servicer has an additional that does all the work basically. The relationship between the servicer and the lender, and the relationship between the servicer and the borrower is governed by a service agreement. Okay, it's another agreement that says, lender, you've just lent a certain amount to borrower. Servicer, I'm going to take care in case that this goes to court. Here's the form act, is the power of attorney for me to act on your behalf to take this person to court. And also it can be that the borrower first will pay to a bank account of me, the servicer, and I will then pay to you. And of course, the servicer will do this for a fee. And then this already begins to get to making sense as far as the economies of scale that are required to do finance. Because if I'm lending just one time to one person, it probably doesn't make sense. But via a servicer, then if he does all the collections for me, then it might make sense. Okay, the point is that the loan is an asset to the lender, a liability to the borrower, and neither an asset nor a liability to the servicer. Okay, if the loan defaults, the servicer maybe gets a bit less fees, that can be in the agreement, in the service agreement, but the loss will be borne by the lender. Okay, the principal loss will be borne by the lender. So the servicer is not on the hook. So in this case, it's off balance sheet. When really the servicer has nothing to lose if the asset or the liability perform or don't perform, then it's off balance sheet. And then in the T account, it's not going to appear. So when asked you to draw the balance sheet of the servicer, the balance sheet that is, if it's a public company, that goes to the Securities and Exchange Commission, that goes to the tax authorities, this balance sheet is not going to show as an asset and as a liability. It's going to be written somewhere, right? Because there is a service agreement between the parties. It's going to appear somewhere, and you're going to see the fees coming in, and the fees will be income and so on. And fees that are due but haven't been yet paid are an asset to the servicer. But the loan itself is neither an asset nor a liability to the servicer. And that's called off-balance sheet. And that's important for you guys to understand if you're into finance, what's off-balance sheet and what's on-balance sheet. That's kind of an important, that's an important thing. So the services activities, as mentioned, the credit decision, often they would also facilitate the payments. Okay, so first maybe the lender would send the money to the servicer bank account, and then the servicer will hold it in custody, and that may or may not be on or off balance sheet, that depends. And then would give this money out to the borrower when everything is kind of signed and kind of everything is approved. And similarly, the borrower may do the repayments first to an account of the servicer, and then the servicer from there would pay to the lender. So facilitate payments, monitors the loan. Usually after 60 days of non-payment, that triggers a default. Depends on under which law, but usually 60 days. After 60 days, you can start taking things to court. Okay, payment reminders, SMS, telephone, in-person. This in-person is not really popular nowadays, not really that much allowed in most places, but still possible. Collection attempts, legal proceeding in courts on behalf of the lender, seizing assets and liquidation on behalf of the lender. Okay, that's really what's at stake here. Okay, if you take a personal unsecured loan, then yeah, at the end, if you don't pay, they can freeze your bank account, and then this goes to court, and then they see if they can take your car, and so on. So, but there's not much more than the house, car, and your bank accounts that can be seized. Okay, there's not much more than that. But of course, also your future income. So they can make any future employee or your current employee pay a certain amount every month directly to lender in Switzerland and in other countries. But in other countries, it's not allowed. So this thing exists big time in Switzerland, by the way. And this is why default rates on personal loans, even if they are unsecured, in Switzerland is probably the lowest in the world. It's damn near close to zero. Close to zero default rate on personal loans, because unemployment here is very low, and then lenders only give out loans to people who have jobs, and that's almost everyone. And then borrowers know that in case they really don't pay, then this will go to their employer. Their boss will find out about it, and then the boss will need to kind of instruct finance department to pay a certain amount directly to a lender. That would be really unpleasant, especially in Switzerland. It's kind of a small place. Everyone knows everyone. Everyone talks about everyone. So the result is that there's a very low default rate in Switzerland of personal loans. Any questions so far? Okay, bond trustee. So there's a problem for bond investors, and if it's a problem for bond investors, then it's a problem for bond issuers, right? If nobody wants to buy a bond because there's a problem of coordination in case of a default, who's gonna appoint a liquidator or an administrator? If there's a problem of coordination because everyone has a small investment in the bond, then none of us have an incentive to do the work to put this company into administration and then put all the assets into an auction. None of us have the incentive to do this because each of us have only a small stake in this bond. And if it's a problem for us, then it's a problem for the issuer because we would never invest unless there's already in place a mechanism to make sure that if things go badly, then we don't need to now say, well, you do it or you do it or someone will do it. But that's okay. You start young and you have this, and then you lose it over the years. Some people never lose it, but there's someone else who take care of it, and never even doing the homework to find out how exactly and who exactly and what is the mechanism, the incentive for this other person that will take care of it. This kind of laziness, then it disappears with the years. For some people, not even for the majority. Some people just stay like this. Entitled, it's called. Someone else will do it. But yeah, if you're taking my course, you better get rid of this habit and do your homework, okay? It's gonna pay off big time. Do your homework, it's gonna pay off big time. The world is full of opportunity for disciplined people with a disciplined, common sense approach. Full of opportunity, especially if you were born in Switzerland already, I can tell you, just do your homework and you can, you can have very, very steady, very nice life. Or whatever you want to do with your life is up to you, but financially speaking, I mean, the opportunity is here to just go with the program, and then you can go way above the program if you just invest your money and you don't fall into these behavioral biases that I will talk with maybe in 3 classes. If you don't fall into these one of these traps, then even with the regular salary that you're making in a bank or in a law firm or an accounting firm or an insurance company, the regular salary, if you just move up the ranks like everyone else will complain about their lives, the money being insufficient, but you could be balling, okay? You could be really having a good time making a lot more with the same amount, okay? A ton more, you wouldn't even believe it. Trust me. Just invest your money and don't spend it on silly things. And invest it wisely. The bond trust, now getting back to the bond trustee. So, then we discussed this. Then the bond trustee is in charge of taking care of the interest of bondholders, especially in the case of a default. Okay? Then it's already in the bond indenture, this legal agreement between bondholders and issuer, who is the bond trustee. And the bond trustee will take care of everything if there's an event of default or other event that's specified in the bond indenture that triggers some action from the bond trustee. It's usually a financial institution, or it can even be just an individual with one of these licenses. There's the license, very popular in the UK, insolvency practitioner. So it's a license, you need to do things to get this license, but then you're licensed to take care of companies in bankruptcy, okay? Yeah, it could be any accountant, also you need a license to be an accountant. Yeah, incentive of the bond trustee, the word you're missing, you have to remember, is to maximize its fees and to minimize its workload, right? It's a person usually, or a company, but for the company, the people behind it, they want more money and they want to work less. Because not all of them, mostly accountants are very meticulous, straightforward, honest people. More so than lawyers, okay? But of course, there's very good lawyers out there. And if you just look at if you just bump into the random accountant in the street, you bump into the random lawyer in the street, you have to choose between the two without knowing them. I would go with the accountant. It's much more trustworthy, I'd say. Especially, you can see this by the prices, okay? The first offer that they give, after you negotiate, it can come down maybe nothing with an accountant. Because there is nowhere to really go down. But the lawyers, once you do your research, it comes down dramatically once they realize that you know what's up. So I leave this judgment up to you. I work with a lot of very good lawyers, so I'm not saying anything like that. But you gotta find it. But here I want to tell you that in the past, and there's legislation specifically against this, and that's why in most times you need a license to practice insolvency law, and then you're in the hooks for losing your license and like your livelihood if you don't do it right, because you have to remember that there is the incentive here to fool around. Okay, so this was a company that it was functioning, there was a person in charge of every activity, and everything made sense. But now one or two or more things went badly, and everyone is gonna be notified that they're not gonna get fired, the company's gonna get liquidated, and this administrator, liquidator, now is in charge of selling all the assets and paying back the creditors based on their hierarchy in the liability hierarchy. Okay, like we discussed. Which loan is senior and which creditor is senior and which creditor is junior, that's what I mean. That's the work of the liquidator or the administrator. And here things can go wrong. Usually the creditor, the creditor is in charge, can choose who will be the administrator. And then that usually makes sense because it's my interest to sell the assets at the highest price so I can get the most out of it. But if it's the employees, if this company doesn't really have so much debt, or if their charter says that in case of this bankruptcy, the workers union, the workers association get to appoint the administrator, then these are sometimes not so honest bodies. Or if it's just the court that's appointing a liquidator, and maybe it's an insensitive body that's appointing the administrator, then trouble can arise. So maybe it's just on very high fees that the administrator charges, because they start charging per hour as soon as they get to work, and it's almost everywhere that because it's such a delicate situation and nobody has oversight over them, and then they operate within the law. But you know, oh, this is a joke I just heard now, that a lawyer went to heaven prematurely at age 50, and he asked God, why you sent me here so prematurely? And then he asked, well, according to the billable hours, you're supposed to be 125. Okay. Because he worked an hour, but he writes like he worked 3 hours. Then, so they can do this. And so, but that would still be within the confines of the law. You can't really take them to court for any criminal act if they just inflate it a little bit. You can't really prove it. But other times that they've been selling, the liquidator, the administrator, have been selling assets of companies to related parties on the cheap. Okay, you understand? So maybe I sell the assets of this company to my cousin very cheaply, and I don't bother making so much announcements about this auction, and then nobody shows up for the auction, and then my cousin's the only bidder and he puts a low price and he gets it. Okay, so this happened many times. Yeah.
If a court or if who pays the
It comes out from the assets of the company.
so he's
And they
actually
get
the first one.
First one, he gets seniority over even the employees.
Okay.
Otherwise, it doesn't work because he's coming last. You want me to work, you have to give me seniority, and that's the standard. So there's not a negotiation about it. They get paid first, and whatever is left then goes to the senior creditors, and whatever is left goes to the junior creditors. Whatever is left goes to the equity holders. And yeah, so you can see that they have the incentive to sell if it's a big build, big shiny nice building, and something went bad, but they can sell it, you know, for 20-30 cents on the dollar to their cousin. With real estate, it's a lot harder to do. But the more the asset is illiquid, the more the asset is hard to value, then the more would be the discount when you sell things in auction. But that's also an opportunity. I mean, there's lots of people buying houses in auction for such liquidation auctions or used cars. People, if you want a good deal on a Porsche, maybe you will go to Canton Schwyz somewhere and you find out where they make the liquidation auctions, and you just sit there for like a month or two waiting for the nice deal, and then you get your nice Porsche. Used, but in good condition, but in good price. I don't know. I just thought about this yesterday. Intermediated finance. Okay, we're still we get into intermediated finance. So we're talking about serviced finance, and now we're talking about intermediated finance. And the big difference is whether things are on balance sheet or off balance sheet to the mediator, to the intermediator. Okay, it could be a servicer that if the loan doesn't perform, except for his reputation as a loan originator and for the fees that he's making, nothing really happens if the loan doesn't perform. But if it's really a bank in between or another lender, it doesn't have to be a bank, that comes in between, then the loan is really on its books, meaning the loan agreement that underlies the relationship between the bank and the borrower is indeed between the bank and the borrower. So the bank is giving a loan to the individual, and then the bank finances itself by other means. So the bank, in completely separate, finances itself either by taking deposits from the public, and this relationship is governed by the deposit agreement. Okay, when you open a bank, you have signed papers. This whole thing, that defines your relationship with the bank. If you're allowed to take the money out, if you put some of the money in the savings account, that would be an additional appendix or even a separate agreement. So everything is written there. So you never thought, you take it for granted that you cannot do anything to the bank, because you really can't, because everything they're doing has already been tried and tested a million times. And so for the basic things, you can't really touch them because they're not doing anything bad. And so, but this is on balance sheet. So this would be a liability to the bank and an asset to the bank. Such that if this loan doesn't perform, the bank still needs to pay you back if you bought the bonds of the bank, or still needs to pay you cash, or if you go to the ATM and try to withdraw your cash. So it's completely separate. That's why it's on balance sheet for the bank. Okay, now we're going back to what I've tried to tell you, that a banking license is required to take deposits from the public, and in my opinion, unnecessarily, this license to take in deposits from the public also allows you to lend money to other parts of the public. Okay? Now, it doesn't have to be that these things have to be bundled together, but they are. And I disagree with this. I think that these things should be separate, that if you want to get a banking license, you can, and then you can lend out the deposits of the depositors. That's fine. But there should be also an additional license that says you can take deposits from the clients, and say the clients, they only want payments, and they're not really interested in interest on these deposits or anything. So, and they're not willing that you lend this money out. And then if you get this license, you're not allowed to lend the money out. And I've explained this to you, and this exists, but it's very hard to make this a reality everywhere. This exists in some countries, but there's a very strong political resistance to this, and the biggest resistance is the ego of the economists that are in control of these institutions, because you cannot just tell an economist that he doesn't know the very basic accounting facts of money. Try to tell him this. I've tried to. It doesn't go very well. And that's the main problem, why they cannot get this very basic concept that what happens to depositors in case a bank goes bankrupt. And they say, wow, that's really bad thing, and that's why we have regulation. That's why we put so much capital requirements on banks, because we never want them, because they're so conservative. They never want the depositors to lose money. and that makes sense, that's right. But but that now makes banking so expensive. You want to set up a bank, you need at least 25 million in own equity to reach the economies of scale and to have the minimal amount of equity against future losses. And then if you don't lend out the money, then you're not making the money to justify the cost of equity. So if you want to start a bank, then you have to lend the money that you take from depositors. You cannot just have like a payments, purely payments bank where you give people an account and you just deposit this money with the central bank, because it's not going to be profitable enough for you. And then you have to lend it to make your cost of equity. Otherwise, you're better off investing your money in something else, not in a bank, in real estate. So, and then they came up with deposit insurance to make sure that the depositors never lose the money. But this whole thing can be sidestepped. You can just have a baby license for what I call a central bank depository insurance. Most countries call it an e-money license. E-money license, but institution. But I disagree with this name because it's confusing. It sounds less safe than what it really is, which is credit risk-free. And yeah, please take it with you. Please always question what they're telling you about the regulations, about Basel. I'm telling you, 99.9% of people in this profession don't know the very basic accounting facts of money. So you really shouldn't look up to anyone in this field. It's really one of the fields, and the reason is ego. Because humanity have conquered much more complicated endeavors, computing, rocket science, again, conquered the moon. Humanity is really brilliant what we've accomplished, but the very basic facts about money, so many people in this profession, and none of them know the very basic mechanics, and this all goes down to ego and behavioral biases, because you cannot tell someone that doesn't know the very basic accounting facts of money. It's like telling someone, you're not a man, you're not a man or woman, whatever. You're not who you think you are. You don't have the value that you thought you had. And that causes immense resistance. But please keep this in mind. And what's the problem? Going back to the problems of direct finance, also the diversification. So if I was to lend to just one person, then that wouldn't be diversified enough. I don't want to lend just to one person, because if that person defaults, it's too risky for me. But if I'm lending out to 100 people, that's already enough diversification, because maybe 5 of them don't pay back, and that would be fine, because I'll still get my positive expected return. And then these two issues, that they correspond to things that they've taught us in economics classes, and they're very relevant to finance. So all the legal agreements, everything I told you about different covenants, taking collateral from borrowers, and making sure that that a company cannot increase the executive compensation of the CEO and executive management after they take a loan from us, or after we inject capital in the form of equity investment into the company, or then all these covenants are there to control basically moral hazard. So moral hazard is, yeah, I just lent you money and to this company, and you said you're going to buy a building and renovate it, you had the whole plan, but instead of that, what you did, you just took a bigger salary, and then you said, well, the money's gone, we lost it, and here's a little bit that's left, but I took the salary and you cannot touch my salary. You cannot take it back. Okay, so that's moral hazard. I mean, I wouldn't lend to someone like this, and if I don't have the structure in place, and I know that that's a possibility, then there's no deal. There's no deal, there's no finance. There's no finance, there's no economy. Okay? Economy, as if it's like something that we should all, like it's some religion that we want a better economy. It's not about that. There's no deal. The building doesn't get built, and we're all living in kind of communist Venezuela or something. Okay? So things don't get done. That's the point. Finance is all about things getting done. For that you need money, okay? You need capital. Otherwise things don't get done. And if you cannot agree on the terms because you don't trust each other, because there's not enough strong enough courts in the country to enforce legal agreements, or if there's not enough knowledge about what legal agreements are appropriate, which is really not a big deal. Even in third world countries, you'd find brilliant financiers. So it's really not any big hurdle to entry. You don't really need to be a genius to go into finance. Really not necessary. But again, here goes the problem. Adverse selection is the second one that's very problematic. That it's related to moral hazard. Then if I'm looking at two companies, and it's hard for me to tell which one is a good company, which one is a bad company. Okay, but they know which one of them is good and which one is bad. So then, if I know that they know, and they know that I don't know, this causes a complete market failure. And this Professor Akerlof got the Nobel Prize for this, for showing this in math. What every used car salesman knows, but he got a prize for it for showing this in math. That, let's say, you're a good company and you're a bad company, okay? And you both come to me for a loan or for an equity investment. And you know that you're bad and you know that you're good, and I don't know. So I'm saying, well, let's average them out. So I'm willing to lend at, say, 10% interest rate, because to you I'm not willing to lend, and to you I'm willing to lend. Let's say I'm willing to lend to you at 5, and I'm only willing to lend to you at 15. Then on average it's 10% that I'm willing to lend. But then you would say, yes, give us the loan at 10%, we're willing to pay. And you'd say, no, we're not willing to pay 10% because we're a good company, we're only willing to pay 5%. Okay? Because otherwise it's going to dilute us more than what our activity is. Then I'm going to say, wait a minute, I'm not going to lend to you, because if you said yes, that means you're the bad ones. And you said no, then you don't want it because it's too high. And there's ways to alleviate this. Information alleviates this. But the point is that in math, that you can show that, then there's no deal ever. Okay, and then the whole thing kind of unravels into this. But the way I said it, then after you do that, that's like, then I know that you're the bad and you're the good. Then I would probably be able to agree with you guys after I screened you guys. So that's like Solomon's test. You know Solomon's test? So there's two ladies, they come with one baby and they say, this baby, okay, cut it in half. And the one lady says, okay, and the other lady says no. Okay? But that doesn't make sense either, because no lady would say that, because she would think, and she would realize that if she says, okay, cut the baby, then it would reveal that she's not really the mother. So I don't know if there's any sense to this or any sense to that test. But the point is that information gathering, and that's why the FINMA, SEC, if you want to list a company or a bond, then they define minimal disclosure requirements. Your financial position, your balance sheet, and your income statement for at least the past 3 years need to be disclosed, and they need to be sufficiently detailed in accordance with IFRS, or at least Swiss GAAP. Even in Switzerland, they go by IFRS, International Accounting Standards, and that needs to be audited, and then that reveals the financial situation of the companies. Then I can say this is a good company, this is a bad company, and then there's no market failure, or this alleviates the market failure. And okay, also collateral, then valuation accuracy is everything about taking collateral. If I'm taking collateral, then I need to value the collateral correctly. If I make a mistake there, then I might be lending too much, and then at the end you say, well, take the building. It's not really worth what you thought it's worth. And in both cases, long-term relationships are there to alleviate these problems. Okay, so if it's a recurring game, that's gonna solve the moral hazard, right? You're not just gonna run off with the money after I lend it to you, because we've done this already many times. And it makes sense for us, so we're gonna do this in the future again. So if you're a real estate developer, I'm a capitalist, I give you the money, you build this building, you sell it, you take some of the profit, you give me some of the profit, then you move on to the next building, okay? So people have relationships like this with real estate constructors for their entire lives. Very symbiotic relationship between a reputable real estate developer and a wealthy family. So they can have a symbiotic relationship that goes in through the generations. I've known this. Long-term relationships. And long-term relationships also reveal more information, right? If I just met you, it takes time, right? Maybe, first appearances is not everything. Things take time. So this you should also remember with relationships that, it can start off all lovely, but, things get revealed over time and it can go sour. But it never goes like through the roof, okay? It kind of builds up slowly. But if it goes down sour, that can go fairly quickly. So that's true about relationships. Just a little bit about the size of the industry. So this is already quite old, but yes, and since then I guess it's grown. So look how many assets are on balance sheet of these banks. $2.6 trillion, $2.5 trillion. You realize how much money that is? $2.5 trillion. It's huge. It's huge. It's really not necessary because you can start a finance business to broker real estate loans with just 5 people and broker like $5, $6, $7 million worth of loans every year, and you take 3-4%, you split it between the people. That's already profitable for everyone. It's already economies of scale. So that really, how to explain this humongous balance sheet? Yeah, if you see their executive compensation, on these huge balance sheets, and they're leveraged 20 times, and half of their liabilities, financing sources are free because the public's deposits, and they don't need to. There's not enough competition that they need to pay anything on that, and they're still barely making 10% return on equity. So they have this much equity and this much leverage. And still they're barely making 10% return on equity for shareholders. And it's like a mystery. How can this be? And it's like costs and like this. Yeah, but if you add back the executive compensation, you're easily making 25%. And even 25% is not enough for a 20 times leverage balance sheet. So again, this goes back to this theme that I'm trying to give to you, that there's a natural monopoly in many areas of finance. Money is a natural monopoly. Capital separately from money is a natural monopoly, right? So money is a natural monopoly because we are only going to use the money that everyone else is using. That's how Swiss franc came to be. Swiss franc is a natural local monopoly here in Switzerland. And capital is also a natural monopoly because I've just explained to you that capital gives birth to a rent all the time. So the rich are getting richer, so it's a natural monopoly. But there is also an unnatural monopoly in money because there is no need to give exclusivity only to banks to give bank accounts. You can do this directly with a central bank, maybe via a very simple intermediary. And then you don't need to give them. So there's the confluence of a natural and an unnatural monopoly. And in my opinion, again, I can't prove this, it's not a fact, but in my opinion, just have your judgment, go through life in this profession yourself, that the result of this unnatural monopoly and deposit taking, the result of that is huge balance sheets of relatively a few number of banks globally and humongous compensation packages that stay with the same people for 20 or 30 years. Look at Jamie Dimon, how long he's been running JP Morgan, is the biggest bank in the world. The same guy has been running it for, 20 years. He took maybe 200 million for himself. You think the guy's a genius? You think what's he doing? He's going on TV, is making all sorts of commentary. Look how much commentary I'm making. I cannot make the same commentary. I do it for a fraction of his cost. Of course, he wouldn't make it wouldn't be the same thing, right? Because people tend to believe that because they've seen the same face for a very long Just a little bit about the composition of we go until the round hour, right? Okay. So just a little bit about the composition of the bank's balance sheet. So it's usually about 40% of the liabilities of the bank, of a bank, is from the depositors, and then maybe another 40% is via bond issuances. 5%, it's not 12 really, it's just 5%, these big banks. So this is an average in the US that includes also the small banks. Small banks have higher capitalization. The big banks have about 4% equity relative to assets. So they have 4 here in bank capital, and maybe 40 in deposits, then another 40 in bonds that they've issued, and some other liabilities related to derivatives and stuff that just appears on there, but you really need to look into to understand what you mean. And then on the asset side, they have much less than 15%. They have maybe, again, maybe about 4% of their assets is in cash with the central bank, which they have to have against deposits that clients can just withdraw at any time. And they have maybe 60% in loans of various types, mostly mortgages. Okay, and then after that, after mortgages to individuals, they have a big asset that is loans against securities. So they lend money to individuals or companies that buy Apple, Tesla, whatever on loan. And then they would lend also, the next asset they would lend to companies. And then the rest of it is derivatives related and other kind of more complicated things that you really need to look into. But that's how it looks like. Any questions on my banking at this point? And so just touching a little bit on crowdfunding. So crowdfunding, and this is it's growing in popularity, and for a good reason. Unlike, I was an early big fan of cryptocurrencies and Bitcoin more than just, what cryptocurrency was. At the time there was only Bitcoin. I was a big fan of that because, as you can understand, if my biggest complaint is about the bank's monopoly in money, then I was an early kind of enthusiast about Bitcoin. That worked out well for me, but what it has become is a huge kind of fad that people that don't get excited about it because it's the future of what? You don't understand the present, and so people kind of made it more than what it is, and at the same time, this peer-to-peer crowdfunding thing was also kind of equally interesting. But then cryptocurrencies got a lot more interesting in the media and in the public attention, but they still kind of stayed there. And it's not that things are directly relevant, but the loans that are being brokered online are still good, in my opinion, the same as they were, and the hype really didn't come in there. So it's really still a good place to invest your money or to borrow money, finance. This goes 2 ways. It only makes sense for investors if it makes sense to borrowers. And so that's service finance. Point is, any financial asset can be crowdfunded. If it's a mortgage loan that a bank gives, it can also be brokered online by a loan broker. It can be either on balance sheet for the bank or off balance sheet for a crowdfunding portal. So the crowdfunding would be, they would just be the broker. So if the loan stops performing, that's the problem with the investor. They just take their fee. That would be off balance sheet. By the way, also banks, when they sell assets, let's say they sold a loan, they lent money, and now they can sell this loan to other investors, and then it goes off their balance sheet. And also banks often just set up a new SPV, another legal entity that its sole purpose is to purchase loans from the bank. The bank lends mortgages, and then the SPV takes cash from pension plans or other investors, and then with this cash transfers it to the bank, and the bank sells the loans. So this would also be off balance sheet for the bank. things can coexist. They can be, some of the bank's assets can be off balance sheet, but usually it's like for the banks it's on balance sheet, and for the crowdfunding it's off balance sheet. That's the main difference. Each loan can be sliced into as many parts as necessary. So then if it's a big loan, then there's no one investor that is willing to invest this entire amount, but that's not a problem because you could put a little bit, I could put a little bit, and then when the loan repays, we get pro rata, we get proportionally to what we invested, and that makes sense. And that also allows us to get diversified over many loans, because we don't need to take up the whole loan, we can just take a slice in many loans, and then we get diversified. And then the economies of scale of this, they kick in, and it works for still relatively kind of local size. You don't need to build up a $2.6 trillion or $1 trillion balance sheet to make it work. Well, mostly it's already after they've brokered smaller amount and becomes to make sense. Depends if they're brokering personal loans or real estate backed loans or SME loans or startup equity. So these are mostly the things that are being crowdfunded online. The personal loans have become very IT intensive because there's a lot of individuals coming in for relatively small loans, and in order to compete in this market, then the crowdfunding portals and other lenders, this has to be very IT intensive, so everything is kind of automatic. The person uploads their details, and this kind of credit decisioning is done automatically. And but for real estate backed loans, it's still rather manual. It's still manual, so it needs to, the property needs to be checked by a person, an evaluation company. So it's still manual, but it makes sense economically that it's still manual because every deal is big enough to justify going into all the details of what the asset is worth. So then these ones, you can really, a team of 4 or 5 can already build their crowdfunding and start to make money after they reach a certain size. But the personal loans and the hurdle to entry is significantly higher because it's become very IT intensive. So it's really hard to set up a new one and to compete with the existing ones. And startup equity, again, very low barriers to entry. So anyone can put on Crowdcube or Kickstarter, a new project, and people would click. And these things are usually not a good investment. I don't want to be so inclusive. Maybe you can find a good deal, you can find the next Tesla or the next Google there and you can finance it, but I highly doubt it because they don't even publish their realized returns because you can't even measure them because you raise money for this company and you never see dividends, or maybe after 7 years you see dividends on very few of them. And there's not an active market to trade these shares of these private companies after they've been issued first time. So you can't really see the price, you can't really calculate the return, so you have to assume that it's negative or like insufficient. Regulation. So in some places they've made specific regulation for crowdfunding, for peer-to-peer lending, that kind of acknowledges that this thing is now become kind of, finally people discovered it, even that this model made sense from the beginning of time, but now it's kind of because of the internet, as if internet didn't exist for a long time already, but this now is coming to be more popular. People are kind of discovering this and rediscovering what is already there. But usually there is a law, there's a regulation that's kind of underlying is the law, that if you make a loan to an individual, then you need a license, okay? Because you can't just lend, there needs to be certain rules to protect the borrower. If it's an individual, then there's consumer protection laws for consumer lending. In the United States, there's the Truth in Lending Act, TILA Act, Truth in Lending Act. If you transgress on that, boy oh boy, you're going 20, 30 years in jail. And there's an interesting, and then separately, there is a license to regulate taking investor deposits. These are two different activities by law. They said anyone that's taking money from the public is required some sort of regulation, depends on the purpose, depends on the country. And also giving loans to individual, that's a separate law, then a separate license. Sometimes in some countries they put the two things together and call this the Peer-to-Peer Crowdfunding Act, or like a side legislation, and then the two things are together. The point is on the taking investor deposit, the main issue is minimum reporting standard, but then another thing is that the company cash, if I'm the loan broker and I need to pay my expenses and I take my fees, that's my activity. And I keep some cash for that. That needs to be separate from the client cash. And also the loan assets, sometimes it would be disallowed that me, the operator, the servicer, sometimes the servicer would also borrow money and buy the same loans that it's brokering and servicing. And that's really not desirable in most cases. So some of this regulation explicitly disallows that, and that's a good thing. And we can discuss this some other time because we're running out of time. And in some of them there is a secondary market that you can sell your loan parts after you've invested initially to other investors. And there's auto invest. This is mostly relevant for the personal loans part, because personal loans, they come in a lot every day and you want to invest a little bit in each one, and then maybe you don't want to click it, you just click it once, define some parameters, and then the crowdfunding operator would have coded already that certain amount of money is gonna go to each borrower. Any kind of questions on this? How are we doing on time? I think we're just about out of time. Okay, so thank you very much. Hope you had fun.